Welcome to today's presentation, where we have the pleasure to present MPC Energy Solutions. To help us through today's presentation, we are joined by CFO and interim CEO Stefan Meisner. Today we'll cover the half-year results you released earlier this morning, and also, of course, your guidance you confirmed. As always, you are encouraged to ask questions in the box down below. During presentation, we will make the presentation and take the main part of the questions in the end. Maybe something will fit into the presentation, but the main part will be in the end. But do not hesitate to put in some questions during the presentation. But I think for now I will hand the call over to you, Stefan.
Thank you, Michael. A very good day to everyone joining this call today, and a warm welcome back to those who have been following us regularly over the past quarters and years. Before I present our results for the first half of the year and then give an outlook for the coming years, I would like to underline what our company does, what we focus on. And for me, that starts with looking back 12 months and really recognizing that today we are a different company than we were a year ago. And when I say different, then I say better, I mean better. And when I mean better in every way. Of course, the most tangible change that we've seen is the foundation of it all, which is our portfolio. 2024 is the first year that we left the initial ramp-up phase of developing and building projects behind, and we now have 5 projects fully operational for a full year. And naturally, and this will be presented during today's call, this positively impacts the top line, the bottom line, and overall creates just a solid basis for what's to come next. Secondly, and perhaps more importantly still, is that we made, in my view, very necessary changes to our strategic focus. We are still a full cycle IPP, but the development phase I consider now to be the core element of our business, and it always should have been. And the change at the top last year has allowed us to make this necessary adjustment, because the development phase is where we create the greatest value. And we need to make sure that this value is actually visible and that we benefit from the work that we do during the development phase. And this can only truly be accomplished if we decide, once a project hits the ready to build stage, that we de-risk the project for us by bringing in a co-investor that shares in the construction risk and the operational risk. And at the same time, we take money off the table early and therefore boost our returns and benefit our shareholders and our cash flows. This greater emphasis on development that we have now defined is also aligned with what I would call a narrower focus on the markets that we believe are most attractive in the region and that have, in our view, the most favorable environments. Originally, we spread out across the entire region, from Mexico down to Colombia and all the way into the Eastern Caribbean. But I believe it's important to acknowledge that not every country is a good fit for us, and that we decisively moved out of some of these markets and concentrated our resources on countries like Guatemala, Panama, El Salvador, and also the Dominican Republic, was a very important step. And most notably, of course, this was also underlined by our exit from St. Kitts, by our exit from one of the Puerto Rican projects that we had. And we're making good progress, really focusing our resources here. And if you take all of that and you pair it with the great cost control that we have put in place, with the reduced overhead spending that we've demonstrated, and year over year we are 30% below the cost level that we were at last year, there's plenty of reason, I believe, to be positive about the prospects that we have and to really grasp the value of our company. So based on the solid foundation, the strong operational performance that we focus on, pushing the development progress, bringing in the co-investors, adding project debt where there's still room for leverage, especially if interest rates, come down or at least stabilize, and keeping our overhead under control. That's really what we're committed to this year and the next year. And as I said before, this is very much already reflected in the solid results that we have shown for the first half of the year, which brings me to that point. So as I said, 5 operational projects are currently part of our portfolio, and they have been fully operational since the beginning of the year. And it shows across the top line when we look at the output of these plants in terms of energy produced and sold. It's shown in the project revenue, which is more than 50% above the same period last year. And it shows both in the growth of the absolute operating profit reflected in EBITDA, and also in the margins that we see are improving across the board. So these key KPIs, they're all up significantly year on year. And some of these, let's say, some of this trend is supported by just simply putting projects in operation like we did. But we also see continued high energy prices, and in part, we benefit from that, just as we benefit from inflation on the top line. And it's also because we have eliminated certain technical risks and certain off-taker risks that we had 2023, for example. So overall, I think with nearly 60 gigawatt hours generated, over 6 million in project revenue, and nearly 4 million in EBITDA, which is doubling the number from last year, this was a very, very solid first half of the year with continued growth and higher operating profits and margins. And this is the trend that we want to continue throughout the year if we compare it to 2023. If we drill down a little into the different projects, we see a kind of like a mixed picture, but despite this mixed picture, we are seeing the overall positive trend. We have excellent contribution both on the top and bottom line from our projects in Mexico and El Salvador, as it should be. And we also saw from one of our Colombian projects that is now operational, actually started operation in December last year, that we are seeing good output. But not the entire portfolio is performing the way that we would like it to. We've seen some issues in Puerto Rico where the engines are basically not running of our combined heat and power plant because the gas that is supposed to be supplied by the off-taker is simply not being supplied. So at the moment, we're in a situation where we're not really generating any energy, but we're allowed to invoice a contractual minimum, and we still see revenue and profit contribution, even though the engines are not running, which is seen here by the significantly small energy output. And then we have one of our Colombian projects, Los Girasoles, where we had to implement some additional security measures in the region that naturally increased costs for the project. But at the same time, we also saw a metering issue, which triggered an energy purchase in the market, which we did not plan, and this really lowered our margin for the project in the first half of the year. We're rectifying the situation, and this will not be sustainable. This project will also perform around the 70 to 75% EBITDA margin. It just wasn't able to do so in the first half of the year. But again, regardless of some of these issues in Puerto Rico and Colombia, we're still seeing an overall good picture, a picture that's good enough in the first half of the year so that we can confirm our outlook for the entire 2024, which I will speak on later. Also important, we announced this last year, is that we keep our costs under control. In 2023, the overhead cost that we had for personnel, for rent, for other overhead expenses was over $5 million, which was simply too high with a company of our size and with a company that had to put a restriction on its immediate growth prospects. And I'm happy to report that we're keeping costs under control. We were 30% below last year's level after Q1, and we maintained that pace. And there's no reason to believe that we shouldn't be able to do that for the entire 2024. And naturally, as profits from projects increase and our overhead spending remains under control, that increases the possibility that we will also break even on an operational level for the entire group, even if we just look at consolidated numbers and not just at proportionate numbers. Moving away from these proportionate numbers and going to the group numbers, just highlighting a few things, also on a consolidated basis where we do not include the performance from all projects because they're not consolidated. We're seeing an upside in revenue. We're seeing the costs are under control. We're seeing an excellent increase in our group EBITDA, which was negative a year ago with $900,000 nearly. Now we have 1.7 million positively to report. You see the margins are up. You see the costs are under control. And this really, I think, is the story that we have to tell here. We have an operational portfolio now that is making the scalability of our business and the run to profitability visible, so that 2024 will indeed be the year where we will see what this company can do, even if our biggest project in Guatemala, which we will speak about later, is not yet online, and that project will in itself be even more transformational. But we're on a good path regardless. We look at some other financial parameters. We still remain what I would call underlevered. Our equity ratio is 50%, way above what we usually see in the industry and with our peers. This, of course, because projects in Colombia and Puerto Rico that we have remain unlevered. We're in talks to finance the project in Colombia so that we can bring this equity ratio down, make sure that we free up some cash, and thereby, let's say, get to a more sustainable capital structure across the entire group. And if we look at our adjusted earnings per share, we say adjusted here because we took out non-cash relevant FX effects that just come from currency translations within our books, consolidated numbers. We are also nearly breaking even for the first half of the year. You compare that with last year, you will see that this is a significant improvement. Another indicator that we track and that we report to the market is the free cash position. What do I mean by free cash position? The free cash position is the funds that we have available to invest in projects, to pay for project development, to spend money on personnel and other group overhead. So this is the cash that we have, and we exclude everything that is inside projects or that we have deposited to secure bank guarantees or the like. And our cash position, free cash position, went down significantly in the first half of the year. This was driven by the largest investment that we've made to date. We deployed over $8 million into the project in Guatemala to fund construction, and I'm happy to report that the construction is really progressing well. We have secured the debt financing, we have provided all the equity that's needed for the project, and this explains why the free cash position is down significantly, even though it's stable now if you compare June and July. And some people might say that this is a little bit worrisome, but we don't think that's the case. We are bringing in a co-investor for the Guatemala project, so most of the money that we deployed in the project, we will recoup by the end of the year. Secondly, I alluded on this before, we're in talks to finance one of our Colombian projects. We don't know what the debt sizing will be, but this is basically money that once we sign the loan agreement, that money will flow back to us as free cash that can then be deployed or used in another matter. And on top of that, we shouldn't forget that we are keeping our costs under control. So even if we have less cash available today than we did half a year ago, there's no reason to believe that we are running out of cash anytime soon, because we have sources to ramp up that free cash position. And since we have no real project commitments at this time and our spending is under control, the cash burn is much lower, and we can use a lower free cash position for much longer than we could a year ago or 2 years ago.
Just to clarify, your equity part to the San Francisco project is done by this. You have delivered the cash you need to that. If it's under the current budgets, then it will be built finished. So there is no more obligations before that park is up and running. Who needs to go from you? Is that how I should understand this? And then of course you have the possibility to farm down and such thing. But you are finished with your obligation that should come from the free cash. Is that correct?
Absolutely, yes. Unless we run over budget, which we don't anticipate to do. And the budget that we have for this project already includes a significant buffer for cost overruns. And there will be no more commitments, and we can put this project online without selling something to somebody else. It's fully financed, and no further commitments exist at this time. All right, something that many of our investors have asked for is that we present the structure of our balance sheet in terms of book value per share, so that they can get a feel for, if you see the balance sheet of our group, if you understand that this is a fair value balance sheet and you believe that the balance sheet actually represents the fair value of our equity in our company, then you could also conclude that over 30 NOK per share is a fair value of the share at the moment, which is trading around 13 NOK today, so significantly lower. But this is just something that we want to present on a continued basis, just to give an idea really about how we break down the assets and the values in our balance sheet and what kind of debt is up against that. But at the end of the day, whether you believe in the book value or not, even if you say, look, the book value is maybe 30% overstated because I'm making certain adjustments, it's still significantly above where the stock is trading today. And I understand that investors would like to see this. That's why we're happy to reintroduce the slide and also update it on a continued basis.
And maybe to some new shareholders understanding it, can you run through the three big green parts, just to understand, to tell what is that you put on top of your book value, and then of course, the big one on the red side, I guess, is the debt and the debt obligation. So just to kind of say what is this now? We know it from the shipping industry, but here just to kind of clarify the big swing factors, if you can run through.
No, absolutely. So of course, because we are an infrastructure business, we build real assets. At the end of the day, these real assets, solar plants with all their substructures, the modules, the inverters, the cabling, everything that's part of it, that's the property, plant, and equipment. And that is this big green bar here on the left. These are real assets that you can go to and you can touch. And because our plants are brand new, if you will, they've just been operational, most of them for not even a year. This book value is basically what we paid for it, net of some depreciation that we took. On top of that, we also have some financial investments like joint ventures that we invest to in our consolidated books. We don't show, the tangible assets that we have there. We rather show the book value of our investments. And this is also what you see reflected here in investments in joint ventures and other financial assets. This is like a shareholder loan that we provide. But this is a financial asset that we are planning to recoup in the coming years. And therefore, the value here is also a fair value that we adjust on a continued basis.
Yes.
And then, of course, it's the cash that we have in the project, the cash that we have free. I alluded on the free cash position. On top of that, we, of course, have cash in the different entities that we consolidate. And at the moment, that cash is still a significant portion of our overall balance sheet and also of, let's say, the total asset value that we have. And then on the right side, what we would deduct is mostly the project finance loans. Projects in our industry are usually financed using 70, 75, sometimes 80% project debt. And of course, that debt has to be repaid, and that debt needs to be deducted in any net asset value analysis. But looking at our balance sheet, and you will find the same if you look at our peers, the three big positions you always have is the actual tangible assets, the financial investments, and it's the cash that you have available. And then on the other side, you have the debt that you ultimately have to repay.
And the tangible asset that's at cost value and not a projection of future cash flows that is calculated in. And in this one, you don't have the potential, you can say, higher value of a project because of cash flows in the future that we should yield a higher value. The value creation you have made on it. Is that correct?
Absolutely. This is at cost, and this is not a mark to market kind of thing. This is just at cost, depreciated over time, and of course checked for impairment every year. Because if the fair value of these assets change, we will not write it up, but we certainly would have to write it down. Our auditors would take care of that. Yeah.
Perfect.
Which brings me to the outlook for this year and also beyond. And I'd like to start by giving a brief update on the San Patricio project in Guatemala, just to remind everyone, we've never done anything of this size. This is a 65 megawatt peak solar PV plant in Guatemala. Once it's operational by the middle of next year, it will basically double our capacity and our energy output. It will contribute over 8 million in annual revenues and over 80% in EBITDA margins. If we look at it on a 100% basis. And this is a project that's fully financed, that is being constructed as we speak, and no additional group overhead costs are needed to put it in place. And there's really, other than getting the construction done, nothing that could prevent us from putting this into place. And just to give you an idea of the progress that we're making, this is a turnkey contract that we've signed with a Spanish EPC company called Indholdet. Indholdet already built one of our previous projects in El Salvador on time and on budget. And they're also the company that we chose to put this plant up and running on a turnkey basis. They have fully mobilized to the site. You can see that earthworks are going on, and these pictures are actually a little bit older, maybe taken a month ago. Fencing work is going on. All of the equipment has been ordered. Deliveries to the harbors in Guatemala are starting in August, and we will see most of the equipment arrive on site between August and October. And the teams are now already starting with the ramming and building of the substructures. So the construction progress in this project is really, really good. And we see no reason why we should not be able to meet the construction timeline that we've communicated before and that we have contractually agreed on with the contractor.
So you kind of alluded or alluded here on the risk you have taken off the project cost or the equipment. It's a turnkey project and so on. But there's a question: what is the biggest risk on the San Patricio project, seen from your perspective? If you say what are the biggest risks now, in order just to kind of highlight that after you have made all these mitigations to the risk. But what is left of maybe as the biggest risk as you see from here on?
So I think construction risks we have experienced in other projects. There's always three things that can go wrong. Either there's a delay in construction for whatever reason, bad weather, deliveries are not being made on time, something is not as easy as we thought it would be. So something is not going according to plan. We see delays, and delays usually mean that the staff would have to remain longer on site, which you have to pay for. You may run into delays, penalties under the power purchase agreement that you've signed. So there's a potential delay risk. But given that the site itself, as you can see, is not super complicated, it's flat land, we don't see a lot of negative impacts like we've seen in Colombia from heavy rain falling for several weeks, and then the soil being damp and not really accessible. We don't believe this will be the case here. So it's a fairly straightforward project to build.
And yeah, so I always, sorry to interrupt you, the connection, the grid connection, that is what I also hear always can go wrong. They are not ready to get connected when you are ready, and the substation and everything is not built into, even if you can deliver. How does it look in this project?
That's a great question. I was just about to mention this. So the substation that we will connect to, and that will ultimately help us feed power into the grid, is being constructed by the off-taker itself. And construction of that substation has started before we even started construction, and they will be finished before we even enter the hot phase of construction. So the off-taker plans to put the substation up and running at the end of this year, and then several months later we will follow with the connection. The teams are aligned, the engineering teams are aligned, they're speaking to each other on a weekly basis to make sure that everything is in place. So I'm not worried that the interconnection for this project won't be ready. The delay risk is more on our side, and with delay risk comes cost risk. And then another thing that I would mention: if the work is performed poorly, if we see quality issues, we may not have an issue during construction, but we will certainly see it during the operational phase. That's the technical risk that we have. The good thing here is that Indholdet is a very experienced contractor. The equipment we source comes from top-tier suppliers like Huawei and the top-tier module suppliers that we see. So also based on experience, at the moment, things are under control fully. No construction goes as planned, but we have 3 people on it from our own team. We have Indholdet as the turnkey contractor, and we have the off-taker, who's of course very keen to make sure that the project can connect on time, because for them it means saving a lot of money on energy. And for them, this is also not the only project they want to see built over the coming years. So I think for the moment, things are under control. Yeah.
Perfect.
Speaking about this project, speaking about the impact that it will have, I would like to conclude my presentation, at least the prepared remarks, by looking ahead in the coming years. And what I'm doing here is not creating some kind of, potential upsides from many, many more projects. I'm just looking at the current portfolio of 5 projects that we have. And I'm adding about half of San Patricio. Why half? Because we want to sell part of the project, and we are always just looking at our economic share in revenues and in project EBITDA. And what you can see is that naturally our own portfolio will continue to grow. We just confirmed our outlook for this year, which is 12 million in proportionate revenue, 8.5 million in proportionate EBITDA. And once San Patricio comes online in the middle of next year, it will help contribute to an upside in 2025. And then, of course, in 2026, when we see a full operational output from that project. So even if we do nothing else, even if we just keep our 5 projects and we add 51% of San Patricio, we can already see, because our cash flows are predictable and they're usually long-term, that this company will nearly double in top line compared to 2023, and it will deliver 3.5 times the operating profit that we saw in 2023. And this is something that I consider to be highly predictable. And unless we experience a real technical issue in one of our projects, or unless we have a problem with one of the off-takers not paying its bills or defaulting, this is what I consider to be a high probability outcome for the coming years. And of course, we don't want to stop there. We want to continue developing and building new projects. But this is what we look at if we just focus on what we have created today, or to this date, which is, a portfolio of 5 projects and 1 project that's under construction. And Michael, this is really all I wanted to share from my side. So let's jump right into the Q&A. I think we've lost Michael, but I'm sure he will be back. Let's give him time to reconnect.
Million in overhead cost, and then of course the interest
cost.
So if you can kind of give an indication on the long-term view on what will be a cash flow effect of this, because in the end that's what matters the most.
It certainly does. So the way that we treat this is that the project EBITDA, we can basically say this is the operating cash flow of every project, because you have revenues, you pay your operation expenditure, and what else is there? Of course, what else is there is the debt service. You have to pay interest, you have to repay the loan that you've gotten. And in the beginning, this is usually a higher amount, and then it decreases over time as the interest load and interest burden decreases. So ultimately, the free cash flows of the project is the project EBITDA minus the debt service. And let's say for the projects that we have looking into 2026, I would say it will be around half of the number that you're seeing here that we should be able to generate in free cash flows. And then this number decreases over time, as I said, as the interest burden goes down. And then you deduct the overhead spending that we have this year of around 3.5 million in the future. And this is, again, now we're getting into scenarios.
Yeah.
If we don't do
everything else equal, that you are not building new stuff.
Exactly. But this is also a point I want to make. If we're not doing anything beyond San Patricio, unlikely, but let's just say hypothetically, then we will not have an overhead of 3.5 million. It will come down significantly.
Yeah.
So ultimately, project cash flows and corporate cash flows, they should, get closer together. The more you turn from a full cycle IPP into what I would call a yield co that is just there to generate cash and distribute it to its shareholders.
Yes. Perfect. Makes sense. Just to get an idea of that. Yeah, but were we ready for the Q&A session, I think?
From my side, yes, absolutely.
Or if you want to run through the investment highlights, or
I mean, I've done this before. It's just a visual aid for the audience, that they know why they should get into the stock and support our company.
Perfect. Then there's a question: when will the loss, or not loss, but when will the loss from the Los Girasoles project achieve your margin targets? It was one of your more difficult targets, and I think you are always targeting around 70 to 80% of in margins. Is that possible actually to get there with all the changes that has been there with security, and maybe a little bit on the time frame?
70% margin for this project is absolutely doable, even with the additional security costs that we're incurring to keep the site and to keep the staff there safe. The low margin that we've seen now is really something that was a technical error in the metering, which triggered a purchase in the energy market that shouldn't have happened. Correcting this entirely this year is not going to work. But in 2025, the project has a fresh start, if you will, and then in 2025, we will see the adequate margins from this project, unless we encounter similar errors like we did this time. But I'm assured by the grid operator and our team that this is really a one-time issue. And so next year the project has to deliver, and this year in the second half we just have to make sure that the margins go back to a level that's more adequate, even with the special impact that we saw.
Then the next question: how do your short-term pipeline opportunities look? I guess cost to build something is still very, very low. Is it $9 10 now per panel, or is it 10? Interest might be coming down. You are kind of talking about stable or maybe a little bit rising energy prices in this region. Some projects must again look better, and do you then have something you can short term start to look at if you get the farm down and the money through the San Francisco?
Yeah, so I agree with you that it's a very great environment to start building solar plants at the moment, and I'm sure that this will continue for the near future. Interest rates, I don't necessarily see them coming down significantly, but at least as they stabilize and we can all have a more predictable environment, that's already a win for us. At the moment, the project development backlog that we have 6 active projects under development. The total is around 300 megawatts in 4 different countries, in Guatemala, in Panama, El Salvador, and the Dominican Republic. The projects are all in different stages. Our top priority at the moment is to sign new power purchase agreements to make sure that we have the commercial basis for these new projects. And ideally, we would start building a project the moment that the San Patricio plant becomes online in the middle of next year. But the world is rarely that ideal. So I'm expecting that we're online with San Patricio, and then it will take 3 to 6 months before we have the next project ready to build. But we're aiming for the end of 2025 and early 2026. And until then, we will just see or continue to see higher revenues and profits from the existing portfolio. We will put San Patricio in place and with the positive impacts on our top line and bottom line that we mentioned before.
Then there's a question: is the San Patricio project included in the net asset value?
No. Well, no is not entirely correct, in part because the cash that's sitting in the entity at the end of June, which was over $15 million in total, is of course reflected. So apologies for that, but it's just pure cash because we hadn't even started really investing into any PP&E.
So there's no future value, taking in on the high cash flow and the cash generation. It's just the cash you already committed and of course haven't used.
Exactly. And at the end of the day, once the project is built and it's put in place brand new, what you will see basically is a net asset value of 8.5 million, because that's the equity that we put into the project to build it. And there's nothing that comes on top of that. But of course, if we sell down part of the project and we're getting cash, then this will of course add value also on a net asset value basis.
Then there's a little bit more helicopter view. Has there been any change with competition you meet when you're bidding on products? And what would you consider your biggest single competitive advantage relative to competitors?
Well, the competition has not changed. This is a very hot, very active region, some countries more than others. We initially planned on participating in a government tender in Jamaica in April of this year. We ultimately decided against it because we said with the return expectations that we have, that we need to deliver our shareholders, and the competition that we would face, we could not win that tender, and the results have now shown we were right about that. So spending more money on preparing the project and entering the tender wouldn't have worked for us. So in some countries, especially in the Caribbean, I would say the pressure on the competitive basis is higher than in the rest. And then it really depends on what kind of access do you have to potential off-takers. It is not really our prime idea to participate in public tenders that everybody participates in or can participate in. We want access to individual clients that we can sign customized contracts with. And that's what our team is working on. And I think speaking about competitive advantage, that's ultimately what's it about. You need the local presence in all of these markets. You need people that know these markets, that have been active in these markets, and that can get these relationships built for you. And that's exactly what our business development and our project development team is doing. So when it comes to the one core competitive advantage that we believe we have over others, it's our access to solid off-takers, to prospective clients, and just the local network to make that happen. Does it make us unique? I don't think a developer per se can be unique, but it certainly has proven to be a success for us in the past few years.
Perfect. And then lastly, and then I'll let you off the hook, in your long-term projection, how do you estimate energy prices?
Well, what we do is, and I think this is very important, most of the projects that we have, they have long-term power purchase agreements in place. I show this here on the bottom right, that we have secured contracted revenues in our projection of over $350 million. This means that these are contracts where we know, or mostly know, future prices that the off-taker will pay for electricity, because we have a base price, we have indexation, or we trade relative to the spot market. And after this PPA tenure, and on average, we're looking at 15 years. So it's really a long-term projection that we have visibility on before we have to start looking into real market projections. And these market projections we create together with local advisors that know the energy markets, that are modeling these things. I mean, I would not say that I could look 15 or 30 years into the future in El Salvador and predict what the energy prices will be, but this is just how it works. But what I'm confident about is that we have long-term power purchase agreement with a high visibility on the contracted revenues and cash flows. And that's what we use as a basis for the projection, especially if we look ahead 2, 3, 5 years. It's not that difficult to know where we will end up if the projects are performing in a normal mode. Yeah.
Perfect. That was all the questions. Thank you for taking us through your result, Stefan, and congratulations with the progress you are showing compared to your targets. May everybody have a nice day.
Thank you so much, Michael. Take care, everybody.